The US bond market, which is the largest and most important financial market in the world, is in a crisis. Instead of a risk free safe haven, US Treasury bonds have started behaving like risky stocks, which could change everything for bond investors, especially retirees who rely on them for safety. That brings us to the crucial question that we'll be answering today. Are US Treasury bonds still safe? To answer that question, I'm going to explain, in the simplest terms I can, what's been happening, what I think will happen next, and how I'm investing around that. Let's dive in. Maybe the most basic core investment concept is that stocks are for long-term returns and bonds are for safety and income. When you get older, you want to take less risks, so you buy more bonds. Every target date retirement fund in your 401k does this automatically. Every financial advisor will do this for you. This concept underpins the entire functioning of the market and how we invest. But that stock-bond relationship is breaking down. To illustrate this, let's take a look back at a couple of past downturns and see how things have changed in this past week. This is TLT, a 20-plus year Treasury bond ETF in blue, and SPY, the S&P 500 stock ETF in red. In 2008, U.S. stocks fell over 55%, and long-term Treasury bonds rose 25%. In 2011, the European debt crisis, U.S. stocks fell and long-term bonds rallied. In 2020, stocks sold off and long-term bonds rallied. We get the point. And this time around, it started out pretty similarly. We actually put out a video in January called How to Profit from the Next Stock Market Crash, which I had a feeling might be coming soon. I said I was investing in TMF, which is a 3x leveraged version of TLT, the long-term bond ETF we've been showing. That's the green line on the chart. You can see it started off pretty strong. From the time we released the video until April 4th, TMF was up 17%, TLT was up 6.6%, and SPY was down 16%, just like I thought it would work. But then this week, everything changed. When US stocks are in panic mode, that's when long-term treasuries usually do the best. But you can see that on April 8th, right after Trump ramped up tariffs on China, both stocks and bonds went down significantly. And at the same time, that continued into the morning of April 9th. But then when he announced the tariff pause, the stock market and long-term treasuries both went up a lot. Then the next day, they both went down. Then the next day, they both went up. This should not be happening. So why is it? Well, I've heard a lot of, let's call them, interesting theories that I don't think have much merit. So I'll briefly touch on the two most common ones first, and then I'll give you what I think are the three biggest real reasons, which all came together to make this happen. Let's start with the two least likely reasons in no particular order. First is that people are worried about rising inflation. True, inflation expectations just hit their highest level since 1981. And true, inflation is bad for bonds. But this is 12-month inflation expectations. And tariffs are a one-time inflationary shot, not something that would persistently impact inflation over 10 plus years. So I'm not buying that one. The second explanation I don't think is real is that China is selling U.S. debt to get back at us for the tariffs. You can see that on April 8th, when treasuries and U.S. stocks were really selling off due to the news that the U.S. was ramping up tariffs on China by another 50%, the Chinese yuan actually got slightly weaker versus the dollar. But if they were selling a ton of treasuries and buying Chinese assets, that would have strengthened the yuan against the dollar. Not only did that not happen, but they also wouldn't want that to happen because that would make the tariffs hurt them even more. Tariffs are a tax that importers have to pay to import something from your country. So they already make imports from China more expensive. Then, if the yuan went up against the dollar, that would make those imports even more expensive in dollar terms. So no, I don't think that was it. It's possible that some investors were selling in anticipation that China may do that in the future, but I'm skeptical that they actually would, and it doesn't appear to have happened yet. What did happen is that the dollar got weaker against many other safe haven currencies like the Japanese yen, the euro, and the British pound. The dollar got weaker against all three on April 8th and the morning of April 9th, then recovered on the tariff pause announcement, then continued to get weaker again. So why might that have happened? I think reason number one is that investors, at home and abroad, are starting to lose faith in U.S. assets because of Trump's erratic policies, and all else equal, they'd rather move money to safe haven assets that seem, well, safer. Think about it. All bonds are based on trust, right? U.S. treasuries are considered a safe haven asset and do well in times of stress because people trust that they will be paid back. I mean, the government can literally print money to pay people back, right? So how would they ever not pay them back? Of course, lots of governments can print their own currencies to pay back their bondholders, but they all have differing degrees of risk that their money might not be worth very much by the time they do. If governments start borrowing too much or threatening the rule of law or doing other crazy stuff that makes investors nervous, investors can easily pull their money out and invest somewhere else. That might lead to high inflation, a weakening currency, and then bondholders might get paid back in 10 years, but the currency that they get paid back with might not be worth very much anymore. The difference with the US is that the dollar is the global reserve currency, so there's massive built-in demand for dollar-based assets. They're required for most global trade, even when it doesn't involve the US. They're required for a lot of countries to maintain their peg to the dollar. They underlie pretty much all commodity futures contracts that countries use to buy and sell things like oil, steel, and coffee beans. So investors usually consider US treasuries to be risk-free. That doesn't mean they can't go up and down in price as interest rates change, but it means risk-free in the sense that there's no way you're not going to get paid back. Now, I think some investors are starting to waver on that. Reasons number 2 and 3 are more technical factors. These are probably the biggest drivers, but also the most complicated, so I will do my best to keep them simple. First, let's take the Japanese yen carry trade. Reason number 2. Did you notice how the Japanese yen moved more than the other currencies and almost at exactly the same time as the US stock market? Well, we did a video back in August about the unwinding of the Japanese carry trade and how that could contribute to a US tech stock sell-off. A carry trade is when you borrow money at a low interest rate and lend it out at a high interest rate. So imagine you borrowed money in Japan, where interest rates were under 1% for most of the last 5 years, and you reinvested that money in higher return assets like US tech stocks, which were on fire and seemed untouchable, or US bonds, which were seen as risk-free and paid you more like 2, 3, 4, or even 5% depending on when you bought. Lots of investors were doing this. But then, as interest rates in Japan started going up lately, which made it less appealing to borrow in Japanese yen, and US stocks started selling off, and people started to lose faith in US policy and US assets, investors started unwinding, or reversing, that carry trade. They sold US assets and bought back Japanese yen, which is why the yen has been getting stronger against the dollar when US treasuries and US stocks have been getting weaker, and vice versa. Reason number 3 is similar. Without getting into all the nitty-gritty details, what happened basically was that hedge funds were engaged in what's called the basis trade at record amounts. That's a trade where they try to earn the difference between the price of an actual bond and its futures contract, which is a financial instrument based on that bond. Usually, these price differences are very small, so they often use massive, say 50 or 100 times leverage to earn a higher return. But when treasury prices fall, the hedge funds effectively get margin calls and are forced to unwind their positions to raise money, meaning selling the treasuries that they own to cover the loans. Selling treasuries makes their prices go down and their yields go up. So here's how it went down to the best of my knowledge. Trump became less and less predictable and more isolationist. Investors got spooked and sold U.S. assets, including stocks and treasury bonds. As U.S. assets were going down in price rapidly with no end in sight, investors that had borrowed money to buy them had to sell them to avoid further losses. That included investors engaged in the Japanese yen carry trade and hedge funds using the basis trade. So what happens next? And are U.S. Treasury bonds still safe? Well, in the short term, like a couple of days, no. And I have no idea how much this technical trading could hurt U.S. bond prices in the short term. But in the long term, the medium term, and even the still pretty short term, like a couple months, I think they'll be fine. And I'm even looking at this as a buying opportunity. Here's why. There are 2 main causes of this stress. One is Trump's erratic behavior. I don't think that's going to change overnight by any means, but he already cracked under pressure when bond yields started rising. This is what he said after he announced the pause in tariffs and bond yields started going back down on April 9th.
Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy.
So Trump knows he can't let bond yields get too high because we have $36 trillion of debt, which he says he's trying to lower with things like Doge and the revenue from tariffs. But his tax cuts will massively increase the debt in the long run if they get passed. And beyond the actual amount of debt, also what really matters is the interest rate on that debt. A 1% increase in rates would add hundreds of billions of dollars per year in interest expenses over time. Rising debt and interest rates would make our debt problem much worse over time. So he knows he can't let them get that high. He can't control interest rates directly, but his erratic policies were the root cause of them going up, and he knows if he tones them down, interest rates will probably come down too. The second cause of the bond market stress had to do with liquidity, meaning the ability to trade, in some specific areas of the bond market that allow the hedge fund basis trade to function. The Fed can, as before, and very likely will again, step in to restore normal functioning of the market if it keeps behaving badly in the short term. So, while I don't know what's going to happen in the very short term, I'm highly confident that both Trump and the Federal Reserve can and will step in if needed to restore calm in the bond markets and keep rates from going too much higher. That's why I do not think that anybody needs to be panicking and getting out of bonds. And I may even buy more TMF, the 3x leveraged 20 plus year Treasury bond ETF that I own, if there's further weakness in the bond market. Anything over a 5% yield on 20 to 30 year Treasury bonds is a great value, in my opinion, especially with a potential recession coming. If we do get a recession, I would expect some combination of Fed rate cuts, quantitative easing, where the Fed buys bonds directly, and a flight to safety among investors, which would all be good for long-term bonds, in my opinion. Keep calm, carry on, and if you enjoyed this video, hit that like button and subscribe so you won't miss the next one. See you in the next video.